Everybody, we want to welcome you to tonight's update for Capital Research Advisors for the first week of November 2010. We appreciate you checking in with us. Before I get too deep into things about what happened last week and what we think is coming up this next week, I do want to comment on something. Somebody that watched the video, read the email, whatever, last week, I commented on QE2, and I actually changed the initials to GE2, meaning guessing at easing part 2. And somebody called and said, you know, they really thought that I was very wrong there, that we need to call it quantitative guessing instead of quantitative easing, and I disagree wholeheartedly. See, when you use the word quantitative in the street usage of it, it means that someone has done some calculation, someone has done some pro forma, someone has set out and worked on it from a historical pricing standpoint or a historical effect standpoint. There's been something quantifiable done about what you're talking about. And I really think that's not happened at all with the Federal Reserve. I think they have absolutely guessed at this thing. I think the proof in the pudding on that is this. Did quantitative easing, or the original version, did it work at all? No, it hasn't worked at all. I mean, we just got the GDP numbers last week, and GDP was basically at 2. And so we don't have job growth. We don't have GDP growth. We do have a really, really low interest rate environment. I'm going to talk about that in just a minute because it just blew my mind what happened this last week in a couple of different endeavors there. But it really is guessing at easing because whatever they used last time, you know, if you want to say they quantified it, whatever they used last time, I think they've run those same numbers again, and they think it's going to work again, and it will not work. The job of a government is not to bring an economy back to life. Here's the big problem with that. If a government could bring an economy back to life, at some point in a capitalistic world, they have to hand that off to the private sector. Well, the problem is that transition is horrible. Okay? If you think about it this way, I'm going to show you some graphics this week. If you look at it this week, when the government decides what it's going to do about an economy, you're going to see a picture of what happens. So you have one decision made there. But when you let the private sector do it, there are hundreds of thousands of CEOs of small and large companies, and their brains are working, trying to figure out how to take advantage of the economy that they've been dealt. So really what you have is, right now you have a room full of people at the Fed. A couple of them are speaking out, by the way. But, excuse me, a couple of folks are speaking out. But then what they're doing is you have about a dozen folks that are sitting in the room making the decision. Rather than turning the economy over to the private sector and letting hundreds of thousands of CEOs and entrepreneurs and self-employed people figure out how to take advantage of the situation out there in the market to be sustainable. Okay? Instead of a room of 12 or 16, you've got hundreds of thousands of people using that collective brain power. Okay? So it's not the job of a government to substantiate or to bring back to life an economy. But that's what we've got going on here. I mean, if you want to do that, go down to Cuba and be Fidel Castro or I tell you what, if you want a great idea, go to Japan and do it for the last quarter of a century and see what you've got. You've got a market today that is worth less than 1/4 of what it was 25 years ago. This past week, someone came out and said they need a $1 trillion stimulus package in Japan. They don't need a stimulus package of $1 trillion from the federal government over there. They need to get out of the way. The job of the government is to get out of the way with regulatory controls and all those kinds of things, and do things that help the private sector thrive rather than spend money. But this past week in Japan, when they came out and said they needed a $1 trillion stimulus package, a guy who works for Citi, but anyway, he came out and he said they need a 100 trillion yen stimulus package helicoptered out over there. I really don't think that would help because, again, that's not the role of a federal government to bring an economy back to life. That's the role. That's what people do, okay, not governments. But anyway, let's shift gears a little bit here. Let's look at what the impact of quantitative easing, the original version, that hasn't worked. It's failed miserably. Let's look at the impact of it. Now, what we do have, they've been pumping all this money out there, but it's been going nowhere because largely small businesses, they can't, not only can they not get the money, a lot of them don't want the money, don't need the money. They don't have the business flowing right now to need the money. Okay, so that's why the stimulus isn't working. Now, it has driven interest rates really, really low. In fact, it's so low that this last week the 5-year Treasury here in America sold at the lowest yield ever. I'm 53 years old, folks. Forever is a long time. And it's the lowest yield on the 5-year Treasury ever, since before I was around. Anyway, now the other interesting thing is this past week, the 5-year TIPS, the Treasury Inflation Protected Securities, sold at negative interest rates. Now, the way a bond sells the way any security sells at a negative rate of interest is people pay too much for the security. They pay more for it than they should. Now, if interest rates don't go up, those people are going to owe the federal government money for buying those securities. And they're going to owe it to them on a quarterly basis. If you really are fearful that inflation is going to turn around and run out of control on you, don't go buy the TIPS and pay negative interest rates on them. Just go short the 5-year Treasury. You short it, and you're at break even the moment the trade settles. And if interest rates rise like you think they're going to, then you'll make money hand over fist. You make a lot more money on appreciation that way than you will on these super cheap 5-year Treasuries that are trading at ridiculously low interest rates. But what that tells you is, when you see those kind of things happen, is the populace is doing that. Institutional buyers are not bidding those things to the point that it's driving those interest rates into negative territory. Institutional buyers would never do that. So it's mom and pop Main Street America that's doing those kinds of things. And brokers get on the phone selling that stuff to people, convincing them this is a great way to absolve their fears, but that's not an effective way at all. Okay? So we're looking at QE1, and we realize job growth's not occurring, GDP's not growing, interest rates are down, but money's not moving. Banks are reporting some pretty healthy profits for the third quarter, but it's not moving America. I mean, we don't have what we need going on here. When you look at the markets right now, breadth is horrible. I mean, it's just horrible what's happening out there on market breadth. Volume is not good at all. The institutional buyers, I don't remember the exact number, I think it's about $2.3 trillion in cash in company bank accounts right now. Companies are not spending the money. Even with the M&A activity going on out there, companies are not spending money. They're sitting on their cash. So they have all this cash, and they're not deploying it. They're not confident that this is a good situation because they realize that job growth's not occurring, exports, even though we've been trying to hold the dollar down so we keep exports going, exports are not rising. Based on what we've done to the dollar, the way we've decimated the dollar here in the U.S., exports are not rising. Now, the G20 meeting is coming up here in Seoul, Korea and whatnot, and everybody said last week that they weren't going to talk about currencies at the G20 meeting. All the countries said that. Well, folks, that's the biggest lie. I mean, the numbers don't lie, politicians do. Well, they came out and said that. I promise you, if you can listen to the conversation, there's going to be a lot of discussion about the currencies. Now, they may not talk about it in the open room with the microphones on and that kind of stuff, but folks, this is the biggest right whale on the planet right now in terms of the economy. And to think that those folks are going to get together and they're not going to talk about the biggest issue facing them from an economic standpoint, that's just ludicrous. But people, the press came out with that, and nobody's really talked about currency since then. Now, you're also going to see a slide on here compares the U.S. dollar to the S&P 500. You'll notice one that they're very inversely correlated. This is just over the last 2 weeks. The slide I'm showing you on this. So they're very inversely correlated, but they have been for quite a long time here. But beyond that, you'll notice they haven't gone anywhere the last 2 weeks. And I don't want to read too much into it, but the last couple of days when the dollar slipped back just a little bit, the S&P slipped back with it. They didn't work inversely. And you can't read much into it because it wasn't a big move. It's only a couple of days kind of thing. But here's what happens. The dollar is sitting right down on resistance. I'm not going to give you the exact number, but we're really, really close to the resistance point on this dollar. In fact, it broke through it Thursday 2 weeks ago. and but it closed above that resistance point. Well, if the dollar goes back below that resistance point, and I don't own the dollar in any capacity right now, we're not short the dollar, we're not long the dollar, but if it goes below that point of resistance, I'm shorting the dollar again, because that's a long way down before the next resistance point. And when I say a long way, it's not going to zero or anything. Don't doomsday me here. But it's going to be a strong single-digit slide. Could get into a low double-digits number there, but it's a pretty healthy slip back from where it is if it breaks through that point of resistance. Okay. The other thing is we've got elections coming up Tuesday, and everybody's all excited because they think the Republicans are going to take over the House and stop all this crazy spending, kill the deficit, and all that kind of stuff. Well, folks, the quantitative side of that is that's not what's happened historically with the Republicans. Now, they might do a better job sometimes, but not every time with the deficit than the Democrats do. But they may jump in there. I mean, I think the populace is kind of rattling some cages right now and saying, you better get in there and do your job, and if not, you're not going to have your job for very long. And so I think what we're going to see happen Tuesday, if everything shakes out the way the predictors are predicting, they may curtail the growth of the deficit is really, I think, what's going to happen. That would likely be good for the dollar, so the dollar could rise off that. I think if I had to make a choice right now, I think our next position on the dollar will be a long dollar position. I don't own it today. I know some folks that do, but I'm not one of them. So I think that would be bad for the markets, though, if the dollar starts to rise. The other thing is, if the dollar breaks its current point of resistance and heads down further, that would be bad for the markets. So the markets, I don't think, have a lot of potential strength here, but the numbers are telling me to be invested where we are, and I'm going to jump into that right now. On the short-term index model, last week I told you that we thought we would have a pullback Monday or Tuesday. We actually did. We shorted the Russell 2000. We picked up on that fall. Tuesday, I think, was a big day, down day on the Russell 2000. Got a nice pop there. At the close on Wednesday, we went from short Russell to long Russell and long NASDAQ 100 at the close on Wednesday. So we got a little bounce there on Thursday, Friday. On the intermediate term model, we're still on the S&P 500. On the long-term index model, I told you we would probably go along the NASDAQ 100 either Thursday or Friday. We did not get that signal. We're really, really close to it. I think we'll probably go Monday or Tuesday unless this market, something happens here. So that's the short, intermediate, and long-term index models for you. On the sectors model, we still own utilities. They're kind of breaking up a little bit. There's some noise in there I don't really like. We also own healthcare. And I also told you last week to watch internet. So those are the three sectors that we would be focused on going forward from here. In the alternative asset class model, we own emerging market debt. We own some. I'd like to add to that. We haven't done that yet. And I also said that the buy for here is Germany. I think Germany's probably the healthiest market on the planet right now, but we haven't bought it yet. It's pulling back. We think it's going to be a nice little pullback here. We're going to buy what we hope is the bottom of the pullback. So we're going to be buying Germany at some point here before very long, so watch that very, very closely. On the taxable fixed income model, we still own the high yield corporates in a big, big way there, and we also own some 10s and 30s. We're long the 10 and 30-year government bond. And then on the tax-free income model, where the income is the only tax-free part of that, we do own the high-yield munis there. They're really kind of making me nervous. Several of those are right down on the sell point, so we could be making a switch there. And in that, we're also along the 10s and the 30 treasuries there as well. So go out, make sure you vote on Tuesday. The G20 is meeting in Seoul, Korea, and watch this dollar, watch Germany. And keep your head above water, and thanks for joining us. Thanks so much.